Hey everyone, thanks again for tuning in to yet another episode of the Keeping It Real Estate Show. I just wanted to mention we're super excited. Dan Breezy is going to be speaking at the Rat Race to Retirement event that Brad Sumrock is putting on here coming up Friday, April 26th, April 27th, and April 28th. So make sure to go check out the website, grab some tickets, head on to Dallas. It's going to be a great event, a lot of different real estate investors there, some great networking opportunity. We're also going to be visiting one of our assets on the VIP bus tour on Friday. So make sure to tune into that. So head on over to bradsumrock.com/Dan Breezy, BRISSE. Again, that's bradsumrock.com/Dan Breezy. There's two different options, a platinum buy one, get one ticket. So you'll get two tickets for $397. And then also a general admission for $147, buy one, get one. Bus tour will be on Friday for the VIP or platinum ticket holders. And then the event is Saturday and Sunday as well. We hope to see you there. Welcome back to another episode of Keeping It Real Estate. I'm your co-host, Mike Roeder, and today we have Craig McGrouther joining us on the show. And Craig is a director of business development over at Lone Star Capital, and they have over $500 million in multifamily real estate transactions that they've done. Craig has a background in selling homes. He's sold over 100 homes. He has a degree in urban and regional development from the University of Arizona. And with that, Craig, welcome to the show.
Thank you so much for having me on today and to be on your platform. I'm very appreciative, Michael. How are you?
Most definitely. I'm doing great. Excited to have you on the show. And, if we want to start off, if you want to share your journey into real estate investing and what you were doing before you got into real estate investing and into the current position that you're in, that'd be fantastic.
Yeah, absolutely. Well, kind of funny. A lot of kids grew up wanting to be, NFL players or, play some sort of a sport, right? I actually just wanted to sell real estate. I don't know why, but I came out of the womb wanting to sell homes and wanting to be in the real estate business one way or another. Obviously, the evolution of it has changed a lot, and I'm very grateful for that. But it's kind of been funny. I always knew I wanted to do it when I was a child. Bizarrely enough, I was watching ESPN and HGTV. Don't know why, but it always made sense to me and was what I was doing. So it always just had a gravitational pull to it. I always like kind of the art and science feel of what, home flipping was. And then now the art and science of multifamily, rehabbing properties, going full cycle, and then also finding, creative structures to deals and finding, opportunities and value that beat, market beta returns. So now that's kind of my new passion and thrill away from the home space and more into the investment side of things. So very fortunate to have transitioned from the single family space into the multifamily space, which with a rocket ship like firm. So very grateful for that. And I pinch myself all the time thinking about how I got so lucky to waltz into this situation.
That's awesome. And what, obviously you sold over 100 homes, very decent amount of homes that you sold in the single family space. What skills did you learn in that arena that kind of transferred over to your new position that you're in right now?
Yeah, without a doubt. Well, I think if you're selling anything, patience is super crucial. And then also having to hold investors' hands. So I'm the person who now is fundraising for the firm. It's Rob Beardsley and myself. Rob is the co-founder of the firm, author of multiple books. I'm sure some people, if you've read niche multifamily books in space, you maybe know the name Rob Beardsley. But essentially, if you're selling a house or if you're raising equity for a deal with investors or big boutique capital raisers, institutional equity, there's a relationship building process. There is a trust building exercise. There's a way you present yourself. So those little skills that I learned in the residential space, over my 8-year span in doing so, or 8 year, whatever you want to call it, during that kind of time there really taught me to develop from a sales individual to how to posture things and really just how to convey yourself and message most precisely in order to get investors into your deal or get clients to work with you if it's selling a home. So both businesses, investment space or home selling space, is very cutthroat and competitive. So you better have some sort of an edge and provide extra value to people. So that'd be the little things like communicating, over communicating, being responsive, being proactive, being there for people. You learn those little skills that do very much so translate into other sales professions or other capital raising endeavors. But fortunately, it mirrored and matched very nicely to where I'm currently with Lone Star Capital.
No, I love that. And I think a lot of passive investors can take a lot of information from that and apply it to any investments that they're looking to do out there. Like you said, you're over communicating, you're being proactive, you're building that trust. And when you're dealing with, a general partnership team or a firm, make sure that you have that trust. And if not, make sure to build it before you stick in some funds. And then when you're talking to referrals, ask them how their communication was. Ask if they're being over or being proactive. All those things are super, super critical. So I appreciate you sharing that. Now let's talk a little bit more about Lone Star. So Lone Star has over $500 million of multifamily acquisitions. What are some of the key strategies or principles that have contributed to that level of success?
Yeah, I definitely think sound fundamental underwriting is the name of the game of any business. It's impossible to tell if you're going to hit a grand slam or not, but it is very easy to tell if a deal is going to fail from a structure perspective. So when we're talking about a structure perspective, there's two angles to think about. There's the debt and the equity, right? So a lot of the deals that are struggling right now from the debt perspective probably have bridge financing or floating rate debt, maybe with a maturity coming up or without a rate cap. If you don't have a rate cap, well, then you're kind of SOL, as they say. And if you've got bridge debt on it, if you're kind of in your extension period, you're kind of holding on for dear life and hoping that, you've at least forced enough value for Ensosoft to at least not be underwater on the deal. But anyway, slice it. Those are the two, main ingredients to a deal structure right now. So that certainly is a big problem. So when I'm thinking about, that right there, those are the two things you need to consider on the investment side is how that's structured. And a lot of people are, hurting right now, but how we've been able to stand out is our deals around fixed rate debt. So that's one of the structuring perspectives that we have there is fixed rate debt, and then we didn't get over levered or too drunk on the interest rates in 2021 and 2022. The deals that are struggling are naturally the ones who are over levered, have short-term, debt notes. And, generally speaking, when you want to evaluate risk and an investment, the riskier the investment is all pertaining to the maturity and the lifespan of the loan. So if you have a 10-year fixed rate debt deal and you're not too overlevered, yeah, maybe you're not going to have the highest returns, but you're going to have a safe deal. And I think preserving capital is more important than, hitting grand slams when making an investment. This is not, some sort of cryptocurrency, this, that. There's no hot money in this business. There was a lot of hot money in it before, but I think, as we get to normal fundamentals and market conditions, that will subside. So one strategy or one of the main strategies we have is fixed rate debt and then not getting over levered. And then from a Lone Star, philosophic, holistic perspective, what we buy, value add, opportunities where there is a forced appreciation play. But so many deals recently have been picked over in this kind of part of the cycle where, a lot of deals have been bought, sold, where there's not always actually a value add plan to be done. So truly, using your discretion as to when you want to do a forced appreciation value add deal really needs to be considered. And don't be fooled by a snake oil salesman, a sponsor saying, oh, this is a great deal. Well, look at the sales record. How many times has it been flipped through? There's only so many times you can put lipstick on the pig before it's just caked up too much, right? So you have to consider that there. So that's one of our angles is a value add deal. We've only done one of those so far this year. The other deals we do is, a market rate deal with discount purchase. So we're buying a deal right now in Houston. That is a market rate deal that's at a pretty hefty discount, which is very exciting. You don't see deals that are discounted that often, but that goes back to the sign of the times when we're at with interest rates. And then the third, final, and I think most unique kind of piece that we can bring to the table, which produces some investor alpha, is tax abatement structures. So we'll buy deals in Texas. We only buy in Texas. And one of the big issues if you're in Texas or in Florida is going to be a situation where you're going to have, really high property taxes going up. Obviously, insurance is a variable there as well, depending on the market that you're in. Florida, it's all tier one risk. Houston is the biggest market that we're in. That's also tier one. We've got some, insurances to mitigate, the spiking insurance costs. But if we can eliminate property taxes, which we've done on 10 properties, we're creating outsized returns for very low risk, and we're preserving affordability, and it's win-win-win. So once more, value add, discounted market rate deal or tax minimum opportunities for the long-winded answer is what we do in our strategy.
Got it. I love that. A lot of great information there. And I wanted to touch on a few pieces of info that you said there. So first, you talked about how your deal is structured, fixed rate and not over levering. So, make sure that you're not, getting too many loan dollars so you're over leveraged because that increases the risk. And I love that you talked about risk and it being associated with shorter term loans. And that totally makes sense. If you have a 5, 7, 10-year runway, to work your way through a recession or through a hiccup in the economy, the risk is substantially smaller. And like you said, you might get a little bit lower returns, but your chances for failure go down significantly. So I love that you mentioned that. And that kind of brings me back to my business partner was at an event, gosh, it was probably 4 or 5 years ago. And there was a rocking chair panel. There was 4 guys that had been in the industry for 40 or 50 years. And there was a question that came up, what would you do differently and what would you recommend, to mitigate risk and pretty much make sure that you receive success over your real estate career. And every single one of those gentlemen said, place long-term fixed rate debt on your properties. So it totally makes sense. It resonates with what we're doing as well. So one other quick question here, Craig. You talked a little bit about your underwriting and how you take a look at the debt, how you take a look at how the deal is structured. What's changed in the last 2 years on how Lone Star is underwriting these value add deals and these multifamily deals?
Yeah, that's a great question. And, every market presents a different opportunity, right? Whether it be, early in 2020 when COVID is going crazy and, rents got bumped up from all the money that was printed, right? Every market has a different situation, different opportunity, different times, right? As Wayne Gretzky kind of once said, you don't want to be following the puck. You need to be anticipating where it's going to be going next to make sure that you make the best decision. So similarly, what Lone Star has done to take measures to take a lot of the risk off the table is how we, put our inputs in there, whether it be cap rate compression, how we kind of manage that, rent increases. If Yardi says 4%, we're going to put in 3%. We want to be conservative there because, you change a couple inputs here, you change a couple inputs there, you've got a totally different cake you're making, right? And if you give 10 sponsors the same deal, you're going to get 10 different outputs. Figure that, right? So this is not a black and white binary business. There's a lot of color and flavor to it. So, we're all looking to solve for mid-teens returns. So we're trying to, be very smart and prudent pertaining to the inputs that we put in there. But for a couple things we've done is cap rates. We are really, try to be smart on that for the projections there. Additionally, on that note, rent growth assumptions are super key. And then also, not having a business plan totally wrapped around pushing up rents. There's a lot of supply coming. It's not just in Texas, but it's nationwide. Supply is going to, maybe potentially mitigate a lot of rent growth, right? So we're really not underwriting, big loss to lease there. We're just kind of net, underwriting, rents being where they are and maybe 3% increases. We don't know where in the cycle we're going to get the bumps, but we know that if we hold the deal for 5 years, rents will be higher. So we're going to put in more conservative numbers there, but we're trying to be very conscientious on, supply coming to locations and pockets. For instance, everyone loves the sexy new units in the Galleria in Houston, but in that area, you've got more supply coming in than really on any other spot in Houston. So we like to go to the suburbs area. So where we buy and the inputs that we put into our deals to make sure that we, it can manage our actuals versus performas is a big thing that we're kind of seeking right now to make sure that we can, hold up our end of the bargain pertaining to the projections we show.
Now, you mentioned tax advantages and, how you guys are eliminating some of the property taxes. I would love for you to share a little bit more about what you guys are doing there and how you're, creating additional value in that field.
Yeah, ultimately, multifamily real estate and commercial real estate is just a math equation. So if you can eliminate one of your biggest expenses, you create millions of dollars of value overnight. So Kent, the co-founder of the firm, it's Robin Kent, has spearheaded relationships with the housing authorities in Dallas, Houston, and San Antonio to try to accomplish these unique setups. So he's spearheading those where we offer up some affordability, and in return, we eliminate property taxes. And there's a really nice value that we all get. It can't just be a win for us or win for the city. It's got to be win-win-win. So this is the perfect blend of public-private to achieve affordability because frankly there is a housing inflation crisis going on in this country. So if we can be a partner with the housing authority to cap some of our rents there, provide better units to the incredible workforce in this country, everyone wins.
Couldn't agree more. And I love that you guys are, diving down in that niche of the industry. Now, obviously there's been a lot of challenges over the last couple of years in the multifamily space, and not even multifamily, just in the commercial space in general because of interest rates and what's happened with inflation. Can you discuss a challenging deal or challenging project that you guys have worked on over the last couple of years and maybe how you overcame those challenges?
Yeah, well, it is, as we look at my watch right now, the 15th of April. And if you've been living on under a rock, I'm going to announce to you that treasuries have been up about 60 basis points in the last month. And it's impossible to basically to have any deal make sense. If you're underwriting a deal, you get it locked up before, and then that comes to play. So everyone in the business right now is frankly getting screwed, unless you're a floating rate debt buyer, which is actually not the worst idea if you think right now is the high in the rates. If you can make that happen and buy a deep in the money rate cap, you can make that work. But we're typically fixed rate, buyers. So it's very challenging for us to make numbers make sense pertaining to, we get a deal locked up, a deal is locked up, and then boom, on to the next. You cushion for your debt and whatnot. So it's very, very challenging to make deals make sense when there's all these kind of moving parts on one end of the spectrum, because you get a deal locked up, that price is good based upon the debt. Before, if treasuries moved, a couple of basis points here and there, that was big news. Now we're, so numb to this fact that, you get 10 point, 20 basis point swings, in weeks time, it's normal, but that's not really normal. So it really materially changes the deal. So we've had some fortunate luck on some of our deals, and we've had some not so fortunate luck on other deals. To your point on a deal that was really, really a challenge was actually last year, when we locked a deal up and, treasurers went up 75 basis points and we materially changed. We had all the equity raised, but we walked away from about $1 million on that deal because we couldn't give it our final Lone Star stamp of approval to make the deal make sense. The numbers became too thin. And from a risk adjusted perspective, we just didn't want to, make that happen. Sure enough, believe it or not, those brokers are calling us because they're going to relaunch the deal because they weren't able to sell it between now and then. So, it goes to show that we made the right prudent choice and we weren't the sucker buying that deal. So with that said, that was something that we had to deal with there. And, seemingly that fun of treasury volatility hasn't ended just yet. I don't think it's going to anytime soon, considering all the weird situations going on from a geopolitical perspective, but also with our inflation report. CPI came back at 3.5%. There's a lot of skewing in the job market as well when you factor that, new jobs, but it's really people taking their second and third jobs. So this information is really, really skewed, unfortunately. So there's a lot of weird situations right now that we're in the middle of. But with that said, there's also opportunity if you are a good sponsor, you can raise capital in this environment, you prime the pump and you don't have the stress. Right now is the time for you to kind of soak up a lot of market share and really make your name in the business. We're really looking forward to doing just that.
Got it. Well, I appreciate you mentioning that. And, I applaud Lone Star and you guys for walking away from that deal when treasuries ran and the deal no longer made sense for the investors. And that's part of the risk. If you're getting into this industry and you're going to be the active investor, a lot of times you have to put a lot of money on the line up front. And, you can try to mitigate risk, but sometimes things out of your control can happen. And as you said, you guys walked away from $1 million in earnest money, and that's very, very tough to do. But there is the chance that can happen in the industry. So beware of that.
Yeah. And Michael, I want to kind of reiterate that point as well. I think sometimes investors just see the final numbers that, folks like us make on sponsors, and it can be a pretty penny if we hit our numbers well and do well for the risk we take. But I don't think people really look into as much as the upfront costs and the risks that you take on an opportunity. So if you work with Lone Star Capital, to give us a little ad here, but seriously, if you do work with us, funny enough, there's no pre-closing cost risk that you take. It's an option for you to basically invest in our deals. But on our end, to get a deal locked up on, deals that we buy, which are $35 to $60 million opportunities, we're putting up $350K, $1 million, whatever it may be, a non-refundable day one to get the option to buy a deal, despite whatever may or may not go on in the treasury market or the interest rate market, right? So yes, we, can make a lot of money and we have upside there, but I think people forget the amount of risk that we take here day in and day out to acquire deals. And I think when the market's like this, it's really displayed as to how challenging the job really can be. I don't want any sympathy here, but I just want a lot of LPs to think about sponsors that, this is truly on our end a tireless business at points. And right now we're kind of in the middle of it. It's very fun, but it's also kind of scary and, can give you a little bit of a gut check from now and then. But just for investors to realize that this is not free for us to transact. There are not tens of thousands of dollars, but hundreds of thousands of dollars and millions of dollars on the line every single deal that we don't recoup if the market, goes to heck in a handbag, if you know what I mean. So,
yeah, no, I appreciate you mentioning that. And that's the exact same way that we operate. And, that may be something that limited partners want to look into. When you're reading the PPM or the operating agreement, when you're looking to invest and the deal hasn't closed, make sure that you're going to get all of those funds back if the deal doesn't close. In my opinion, that's really how it should be done. So I appreciate you mentioning that. Let's shift over to significant trends. So let's talk a little bit about significant trends that are happening in the real estate industry space right now. What trends have you seen that have came up over the past couple of years, whether it be with value add or just multifamily in general or debt markets? If you could speak more on that, that'd be great.
Yeah, some trends that I've noticed what people want. I think we've been pretty or very solid on this is having deals with positive leverage. And for those who don't know what positive leverage means, it means your cap rate, your going in cap rate is higher than your debt. So there's a nice inflection here, right? When you have that, let's say your cap rate going into 6.5 and then your debt is 6%, then you have 50 basis points of positive spread there. So that is a situation where you're already, above water there, and you're going to handsomely and comfortably hit your DSCR, your debt coverage servicing ratio. So that's been kind of one of the key things there. And I think people aren't talking about this enough, but I think so many people are trained to see the very pretty kitchen that looks like yours after you go full cycle on a deal. They want to see, the disgusting, ugly Formica countertops with that really dated, ugly, gaudy, the popcorn ceilings, to the bright, light place that looks like yours, right? I'm sure yours is a little bit nicer than what we put in apartment complexes, but you get my point, right? A lot of investors are trained to see that. But I think people need to realize they're trained for a mid-teens return. They are a mid-teens return investor. So that can come from multiple ways. So don't be, fooled just by, seeing this or that as to why a deal may not, be value add with return like profiles. So I think people really need to think about, you are a value add returns investor, not a value add investor as much. So there's less deals that will be value add like, but I think right now what you want to be investing in are deals that have some form of positive leverage or a very clear path to, neutral or positive, yield on cost there.
Craig, how about challenges in the industry? Obviously, we've talked about the debt markets, talked a little bit about rent growth and supply. Any other challenges that you see coming down the pipeline in the multifamily industry, rolling into 2024 here or out, the next couple of years?
Yeah. Well, hopefully you haven't had this before, but have you ever been bit by a snake?
I have not, luckily.
Yeah, well, neither have I, but apparently they don't say it feels very good. A lot of investors right now, similarly, are metaphorically snake bit because they're in deals that have been taken back by the bank. They're in deals that are getting capital called. They're in deals that are just going to barely survive and be, all these things if they're still, able to hold it as zombie deals. So there's going to be a lot of deals right now that, they're in with other sponsors, of course not with Lone Star Capital, but with other sponsors that are not doing very well that are investors as well. And instead of putting new money into a new deal, they're going to have to put their $50,000, $100,000 into a capital call to keep the life of the deal going, which has negative sentiment. So, equity and liquidity is going to tighten a lot right now. So there's going to be a challenge just to raise equity for any deal coming up. But let me just make this a PSA. When it's hardest to raise for a deal and when it feels worse to invest is when it's the best time to invest. Period, point blank. You can ask anyone who's been in the business. I'm not that I'm Warren Buffett over here, but just think about the logic of that. When it feels best, it's probably the worst. And when it feels the worst, it's definitely the best. So that's kind of my 2 cents on what we're seeing right now, generally speaking. And, if you're crazy enough to invest, in 3 caps and 4 caps or even 2 caps, then why wouldn't you invest in the same kind of product type when you're seeing, north of 5 caps and north of 6 caps, right? That's where you want to invest right now. So there's going to be a holistic capital raising issue for a lot of sponsors. We're fortunate where we've been oversubscribed in our deals, but there's not enough good deals to buy because debt's making it very difficult to pencil. And there's going to be, challenges in the equity raising market due to a lot of people, being in deals that are having less than desirable outcomes.
Yeah, I couldn't agree more. You look back to 2008, 2009, and as you moved into 2010, those are some of the best deals out there in the single family market. Massive discounts, but a lot of people were skittish, very, very afraid to jump in because you had that massive dip. Same thing right now, multifamily space though, we're seeing 20 to 35% discounts, on multifamily properties. And like you said, there's a lot of people that are skittish because of what's happened over the last year and a half. But I loved your remark. If you invested in projects 2 years ago at 2, 3, 4, cap rates, right now cap rates are in the 5s, the 6s, maybe the low 7s. What a fantastic time to jump in, if you can find the right sponsorship team and the right deal.
Yeah, I'm a basis buyer, an investor. I am not an interest rate investor. I think interest rates are silly in many respects. They obviously can juice up and help deals out. But, debt, especially in the commercial space, is incredibly temporary, right? It's all about having a good basis. You make your money on the buy and the sell, and if you have a higher interest rates, you're probably buying at a compressed purchase price. So seek deals like that. The rate should be a non-factor. You are trained to look at the wrong thing if that's the case. Be trained to look at the basis and relative to rent prices and a couple other metrics that seem solid. but do not be trained for the interest rate. That was a fake world we were living in before with rates there before. They should have never gotten that low. That's a topic for another day. Maybe that's part 2 of the podcast coming back, but do not be an interest rate investor.
Completely agree. And Craig, what advice do you have for investors that are just looking to get started in their real estate investing career, whether it be passive or active?
Yeah, I would just say stick to your fundamentals and trust your gut. Don't try to put a square peg in a round hole, especially right now. You can still buy bad deals. You can still invest in bad deals in this marketplace right now. So go slow into this. I think a lot of people, listen to a couple of books, listen to, a seminar, go to an event, get so gung-ho, ready to go that they don't think about anything else and they just want to, force. I'm going to make it happen. And I'm all about taking massive action. But go slowly into making a 5-year permanent decision, and be smart with that. Trust your guns, and be prudent with your choices and your capital.
Makes sense. And before we part ways, I'd love for you to give our listeners a book recommendation or even a podcast recommendation. Something that's made some positive impact on yourself. Any recommendations at all?
Yeah. So the number one book is probably a book that other people have said on the show, but Rich Dad Poor Dad. If you haven't given that a listen or a read, I think it's an annual thing. It's reinforced that concept all day long. Please do that. The best podcast in the world is the All In podcast, period, other than yours, of course, and mine. But outside of our podcasts, if we're going through a neutral third party here, the All In podcast is truly the best podcast. It's with 4 venture capital people from the Bay Area. They talk about everything. You just need to be listening to that show. So if you're not, you're doing yourself a disservice.
Got it. I appreciate you mentioning that. So Rich Dad, Poor Dad, phenomenal book. Recently read it to my 11-year-old and she absolutely loved it. So if you have kids, make sure that you introduce it to your kids as well. And, try to get others, family, friends to read that book because it really is an eye opener. And then the All In podcast, I'm going to have to check that one out. I haven't heard of it, but looking forward to it. So Craig, thank you so much for joining us on the show today. If any of our listeners want to reach out and get a hold of you, how can they do that?
Yeah, thank you so much for having me on, Michael. It was a great conversation today. If you want to reach out to me, you can find me on LinkedIn. It's just my first full name, last name. We're all over YouTube. If you want to go to Lone Star Capital, you'll be able to see our multiple weekly shows that we have there. So we're very easy to find. So find me there. And if you want to email me to reach out for any questions, you can find me at craig@lscre.com, and you can go to the firm's website, which is www.lscre.com if you want to learn more.
Perfect. Well, thanks so much for tuning in to another episode of Keeping It Real Estate. Please do us a huge favor if you're listening and leave us a rating and review, as it helps us to continue to bring on great guests like Craig and provide some really good content. So thanks so much, and we'll see you next week on another episode of Keeping It Real Estate.